Hello, ladies and gentlemen. My name is Joseph Novichkov, Senior Commodity Analyst at GDMfx. Welcome to our Candlestick Formations webinar. Before we actually start with the candlestick patterns and formations themselves, let's start with a little bit of a storyline about the candlestick and the candlestick chart itself. So basically, the candlestick charts are believed to have been developed in the 18th century by the Japanese rice trader Munehisa Homma. Now, first they were introduced to the Western world by Steve Nissen in his book Japanese Candlestick Chart Techniques. Now, the candlesticks are usually composed of the body that actually represents a real candle, and it looks like a real candle, as you can see in the presentation itself. Now, regardless of the color, black or white, we can actually see that the candlestick itself presents a lot of information. Now, summarized into a whole chart, we can find out that the more information that we get from the chart, the better we can actually anticipate the next move. Talking about the candlestick at this particular moment, we can see that we have a real body of this candlestick, and we have the possibility to see a shadow on the upside and the downside, which we call an upper shadow and respectively a lower shadow as well. So price excursions above and below are the shadows. Now, to sum it up, between the open and the close, as you can see, between the opening the price and the closing of the price, we can see the real body itself. The shadows illustrates the highest and the lowest traded price of a currency pair during the time interval represented. So what we see above and below the real body, we can see the higher possible price on the upside that actually the recent session has actually reached, and the lowest possible price that the trading session has reached. So as a summary, what we have right now is 4 different types of information from only one candlestick, called a candlestick line. The first piece of information is that we have an opening price. The second piece of information, we have the closing of the price. Third piece of information, we have the highest possible price that the session has reached, and the fourth piece of information is the lowest point that the session has reached. Now, if the currency pair closed lower than it opened, the body should be a black real body, with the opening price at the top and the closing price at the bottom. Respectively, if a currency pair, for example, closes higher than the opening price, the real body of the candlestick line is white or unfilled. It actually depends on how you prefer to see it. So that means that the opening price is at the bottom of the real body, and the closing price is at the top of the real body on the candlestick. Now, let's talk a little bit about the candlestick, that it is not needed to have a body at all. So basically, we can have a shadow up and down, but it's not necessary to see a real body. Respectively, those types of candlesticks are called Dodgies. This is where we're going to move next. There are 4 different types of dodgy lines. One of it, which we mostly see on the chart, is the neutral one. Respectively, we have no real body because the opening and the closing price are at one and the same level. Then we have a small shadow below the opening and the closing of the price, and we have an upper shadow with pretty much the same size as the lower one above the opening and the closing of the price. The second part of the dodges that we are going to be able to spot on the chart is the long-legged dodgy. Now, the long-legged dodgy has a very, very long shadow on the bottom, which is below the opening and closing of the price, and a very long shadow on the upside of the opening and the closing of the price. Now, the next 2 types of dodgy lines, they're actually quite a rare sight on the candlestick chart, basically because they're very, very strong reversal signals. As we're talking about the patterns themselves, we're looking for a reversal signals or a continuation signal to have an idea so we can support our theory for the next price move. Now, the gravestone, we can spot that we have no lower shadow below the opening and the closing of the price, but we have a very, very long upper shadow above the opening and the closing of the price. The final piece of the dodgy line is the Dragonfly, which is pretty much the opposite type of the dodgy line of the gravestone. In that case, we do not have an upper shadow here above the opening and the closing of the price. Now we have a very long lower shadow, which is below the opening and the closing of the price. Now, dodgy lines are among the most important individual candlestick lines. They're also a very important component of a candlestick pattern. Later on in our presentation today, we will find out where exactly we can spot the types of dodgy lines that we can actually recognize a different type of pattern that will give us a hint towards where the next possible move will be. We're moving on to a very important bottoming reversal candlestick line called the hammer. Now, the hammer and the hanging man, they're both in the same lines. They represent a very small real body, white or black. It's regardless of the color. We can see that we have 4 different types. It's with a very small white real body, with a very small black real body, as we can see, and a lower shadow which needs to be at least twice the size of the real body itself. This is how we're going to measure and find out that this candlestick line is called a hammer. Now, talking about the hammer itself, it's not necessarily to see a very clean hammer as we can see it over here. This is a clean, an absolute, beautiful hammer that we are going to spot on the chart itself, but basically to call it a hammer, we can also spot on certain occasions that the hammer itself has a very, very tiny, small upper shadow above the real body, regardless again of the color, whether it's a white real body or a black real body, we still call it a hammer or a hanging man. Now, we're going to talk about the hanging man later on today to tell you exactly what it does. Now, the important thing here to remember is that the hammer itself is a very, very important bottoming candlestick line. So when you see it at the bottom of the downtrend, this is a reversal signal. This is what we are looking for, and we're going to continue with the hanging man for you to see that it's actually pretty much the same, with the only difference is that the hanging man has a lower shadow at least 3 times the size of the real body itself. As we mentioned, the hanging man and the hammer are both one and the same type of candlestick line. Small real body, white or black, regardless of the color, with little or no upper shadow at the top of the sessions range, and a very long lower shadow. Now, there is the thing about the hanging man. When it appears during an uptrend, it becomes a bearish hanging man. It signals the market has become vulnerable, but there should be a bearish confirmation in the next session. Let's say a black candlestick session with a lower closing or a weaker opening to signal that it's a top reversal pattern. As we mentioned, when we're measuring the individual candlestick to find out whether it's a hanging man, we need to see that the shadow below the real body is at least 3 times the size of the real body itself. Now, covering all that, so far what we're using is just an individual candlestick, only one to signal trend reversals or continuations. Now, what will happen is we're going to add another one, and I'm going to present to you one of the very important candlestick formations which we can spot on any kind of currency pair, commodity, security, company shares, stocks, whatever you want to trade it. The only difference is that they look a little bit different, but they're still the same. So there is the moment that I need to tell you that whatever trading, whatever that you trade over there, what you will see is that most of the times those candlestick formations are going to be very ugly. They might not look exactly the same that you see it right now in the presentation. In the second part of our webinar today, we will find them on the live chart, so you can better visualize how they look on the chart itself. For you to see that it's not necessary for the pattern to look the way we can see it over here, a very beautiful pattern. It's called piercing pattern, but they're still the same, and they confirm, and the price is going our direction if we manage to recognize it and, of course, enter our positions at the correct levels. Now, the piercing pattern is a very important bottom reversal signal. That means it occurs in a downtrend. A long black candlestick, as you can see it here, is followed by a slight gap. Now, as we know already that on the bullish candles, the opening is below the closing of the price. Therefore, we have a slight gap on this session. And when that session finishes, we need to see the closing of the price at least above the half of the previous session's real body. So this is what we're looking for to confirm that this is a piercing pattern bullish reversal signal. It needs to close at least above the half of the real body of the previous session. And as you can see it on this picture over here, it's not necessarily to have the same type of gap that we have over here, but it's still a piercing pattern. That is why I'm telling you, whatever that you're trading out there, It might occur a little different to you on the chart, but it's still going to be one and the same pattern. Now, talking about the piercing pattern itself, now comparing it to one candlestick, this one is much more powerful because we have now two sessions that are closing and they're forming together a piercing pattern that is confirming that the price is up for a reversal. Our next candlestick formation will be the dark cloud cover. This is very, very similar to the piercing pattern that we just went over, but this particular candlestick formation called the dark cloud cover is a bearish reversal signal. What does that mean, ladies and gentlemen? It means it occurs in an uptrend with a very long white candlestick real body followed by a bearish candlestick which opens far above the closing of this price and finishes way below the half of the real body of the previous session. So this is what we are looking for. We're looking for a gap if possible, because as you can see on this picture over here, it's not necessary to have a gap, but still the candlestick is finishing way below the middle of the previous session, which confirms that this is a dark cloud cover. So as you can see, the past two candlestick formations, they're one and the same. The only difference is one of them occurs on the bottom of a downtrend, signaling it's a bullish reversal signal, and the other one is occurring in an uptrend on the top of it, reversing, telling us that this is a bearish reversal signal. Now, the candlestick formations, ladies and gentlemen, that I'm actually presenting to you today are actually those type of candlestick formations that are mostly seen on the chart. There are many more, but those are these that actually most of the traders are looking for because they're stronger than the others. Now, let's take a look at another candlestick formation. We're talking about the engulfing pattern. Now, there is a bullish and a bearish engulfing pattern. It's a pattern that very often occurs in high volatility currency pairs or commodities. This is what you can see on the chart. We're going to take a look at it in the next session, the second part of the sessions today. So we can manage to find it on the live chart. We're going to scroll back in time and see what those type of patterns are doing. Now, a bullish engulfing pattern is comprised of a large, very large bullish white candle that actually engulfs the previous session bearish candle. So we have a session in which the price is pressing to the downside. We have a bearish candle, which is a black one in this particular moment, and the next session opens with a slight gap to the downside and of course finishes way above the closing or the opening of the previous session's price. This is what we call an engulfing pattern because it basically eats the previous session, engulfs the previous session. That is why it's so strong a reversal pattern. The bearish engulfing pattern itself is a very important top reversal signal. It occurs, of course, when the selling pressure overwhelms buying pressure, which reflects in a very long black candlestick real body which engulfs the previous session's white real body. This is what we need to look for. The session that we're expecting to confirm to see that the candlestick will actually finish way below the opening of the previous session's price. So we can call it an engulfing pattern. Otherwise, if it finishes a little bit above it, it's going to be a piercing one. Sorry, a dark cloud cover. Regardless of the direction, piercing pattern or a dark cloud cover, in this particular moment the price is continuing to the upside or to the downside, as appearing as an engulfing pattern, bullish or a bearish one. It's very easy to understand it. It's very easy to find it on the chart. We will do that together in the second session. But right now, I would like to add another candlestick line to these patterns to see whether we can get a better confirmation. Now, we already know that one candlestick line is strong. We know that two candlestick lines combined, giving us a signal, is stronger. But adding another one, making it 3 candlestick lines, we will find out in our trading activity that it's going to be the strongest type of reversal signal which you can get. Whether it's a bearish reversal signal or a bullish reversal signal, it's stronger than anything else. The easiest explanation for this is basically because it takes a little bit more time for those types of patterns to evolve, so you can see and confirm that the price is going to change. This is seen in the past, and it's going to happen again. That is why people are looking for it. Traders are looking for it. That is why they're so powerful, only because everyone is entering at one and the same level because they're following the rules. Now, the Morningstar represents 3 individual candlestick lines. The one that you see right here, the Morningstar, is a bullish reversal signal. Now, it occurs in a downtrend. When it occurs in the bottom of a downtrend, we are absolutely sure that this is our Morningstar signaling that the price is going to change to the upside. Now, there are 2 different bullish Morningstars. The one that we see, the first one here, we have a black long candlestick real body, just a slight deviation from it. Let me remind you that the whole time I'm talking about real bodies, this is the most important thing that you need to remember. The shadow does not play a role in this particular picture. It plays a different role, but we're going to talk about it in our next sessions. So then you will find out what the shadow is actually doing. Now, a long black candlestick real body is followed by a very small white candlestick real body, which in this particular moment is actually a hammer, also occurring in a downtrend on the bottom of it, giving us a hint price is possibly going to go up. The third session, what we see here is a slight gap above the closing of the previous session and a very long white candlestick real body. When the next session, let's say the 4th session, begins trading, we're up to see a very long candlestick after that, which is a bullish one. And that is why we call it a Morningstar, because it's rising. Now, you can see on the right side of this one, we have another type of a Morningstar. What we see is a long black candlestick real body, followed by a very small black candlestick real body in this time, and again followed by a white candlestick real body to the upside. Again, this is a Morningstar. When you see it on a downtrend on the bottom of it, and it occurs in one of those 2 types of ways that you can see it in front of you, it is a Morningstar. Now, talking about the Morningstars, let's see the opposite of the Morningstar, which is the Evening Star. Now, everything that you see is pretty much the same. The only thing is that they changed the direction right now. So we have an evening star that's a bearish reversal signal. It occurs on the top of an uptrend, signaling that the price is due to change to the downside. And respectively to that, the two types of the evening stars, a white long candlestick real body, a very small white candlestick real body, followed by a very long black candlestick real body. In this particular moment, you can see that there is a gap, a slight gap between the opening and the closing of the previous sessions. So the next one on the right, you can see a very long white candlestick real body, followed by a black long small candlestick real body. And the third session that confirms that this is an evening star closes with a very long black candlestick real body. This is an evening star, a very powerful reversal, a very powerful reversal. Talking about a very powerful reversal, now we're going to see even more powerful than the evening star itself. It still represents three individual candlestick lines combined into it, but having a Dodgy star in it, we can call it a morning Dodgy star. Now at this time, we have, instead of the middle small candlestick real body, black or white regardless of the color, we have a Dodgy line. As we mentioned in the beginning, the Dodgies are those types of candlestick lines where the opening and the closing is one and the same price, regardless of the upper and the lower shadow. In this particular moment, we have a neutral Dodgy, which is a small shadows up and down. But still, this is the most powerful bottom reversal signal, even more powerful than the morning star itself, basically because the Dodgies are very important candlestick lines that we should not overrule. Therefore, from all of these that we just mentioned so far, this one is the most powerful one. A black long candlestick real body is followed by a Dodgy line, closing and opening one at the same price. Then we see a very long white candlestick real body. So the following session we can expect that the magnitude of this type of position could be with the size of the first candlestick. So if we have a morning star, and if we have a morning Dodgy star in this moment, then we need to have an evening Dodgy star. It's pretty much the same as the evening star, but as we mentioned, putting a Dodgy between the long sections, then we have an evening Dodgy star. A white long candlestick real body is followed by a Dodgy star, which tells us something is up to happen, and the final session closes with a very long black candlestick real body, which tells us that this is an evening Dodgy star, a very powerful top reversal signal occurring in an uptrend. Yet again, ladies and gentlemen, what we have right now is just those types of candlestick formations. Now, you can always use chart formations, double tops, double bottoms. Sometimes those types of formations are occurring in one of the tops of the double tops, or the bottoms of the double bottoms, or the head and shoulders, or the reverse head and shoulders. It doesn't really matter now. What I'm trying to amplify here is that everything combined is making it even more powerful. So that is when you can see that the price is reversing. And during a downtrend or an uptrend, we can see that, of course, the price is trending. But once this type of trend is over, what we might see is not necessarily a sharp move on the opposite direction, but what we might see is a consolidation between two ranges, which means that the price is ranging. So these types of trading strategies, combined with the candlestick formations that I'm giving you right now, can make you a very profitable trader. Basically because when you see those types of formations in a side range, sideways trading, that means an imminent reversal is up to happen between, of course, the ranges that you have already set. Now, what we're going to take a look at after we take about 5 minutes break, I'm going to put up the real chart for you, and you're going to see how those types of formations look like on the real chart. We're going to pick a bigger time frame simply because they're more powerful. The bigger the time frame, the more powerful they are. That doesn't mean that on a small time frame you can't really trade the same types of candlestick formations. 15-minute, 30-minute chart, 1-hour chart if you wish. It's still the same, but you need to be mindful and always look at a bigger picture, because there could be something that can actually invalidate those types of formations that you can see on the smaller chart. My name is Joseph Novichkov. I'll see you in the next 5 minutes. Get ready for the real chart so we can find those formations for ourselves. I'll be back in 5 minutes. All right, we have one of our attendees wants to ask a question. Now I'm putting it to you a live questioning, so you can go ahead and do it. I'm talking about Mr. Lum, if you can hear me. I see that you're raising your hand. Yeah, I can see the question that you're writing. Let me see. Okay, yes, there is a question from one of our attendees here that he was a little bit late for the webinar today. Now, let me remind you, as I mentioned, those webinars are usually recorded. So what you can expect is in the next few days to find it in our YouTube channel. You can watch it for free, so there is nothing that you're going to miss. On the other hand, if you need a type of training, one-on-one session, you can always schedule a meeting with me, so we can, of course, put it in our schedules so we can better find time for those types of sessions. It's not going to be a problem. The only thing you have to do is contact me. You can see in the presentation page my email to contact me directly if you wish a session one-on-one. If there is anything that I can do for you, of course, ask the questions here in the chat, which is relevant to today's topic. Ladies and gentlemen, there is another question from one of our attendees today. Now, the question is, can a candlestick be used both up and down in the market? Now, if I understand correctly, this question is whether you guys can use those types of candlestick formations and candlestick lines to trade the market up and down. Yes, of course, you can use it in an uptrend or a downtrend or in sideways trading. You can still use it. That is why I'm giving you those bullish and bearish reversal type of patterns, so you can visualize Of course, we need to have them so we can find the market direction. This is the first thing we need to do, find the market direction. After we do that, we need to consider our opening positions, and we need to consider the final piece of the puzzle, which is the closing of it. The closing of the position should be at least a few pips, let's say 3-4 pips below the absolute potential of this type of position. Now, those types of strategies, we will take a slight look at it at our next webinars, which is going to be risk management. We can see exactly what is let's say position potential, how to manage the stop loss and the take profit, basically because all of us, we need as traders to protect our investment before starting to make the money. I hope I have answered your question correctly. I'm eager to get the rest of the questions from you guys. Okay, another question we got. The question is about the Dodgy lines. Why are they so important, and why are they making so significant one trading pattern, or in this particular moment, candlestick formations? Now let's scroll a little bit down so we can find those dodgies that we were talking about in the beginning. Now, the 4 types of dodgies, as you can see, neutral, long-legged dodgy, Greystone, or Dragonfly. Now they're named like that because pretty much they represent the real thing. Now, regarding the question, the importance of the Dodgy line, of course, is only because there is indecision on the market. This is derived from the fact that the opening and the closing of this session is at one and the same price. Just imagine for a moment that the bulls and the bears, let's say they have on every side a gang of 10 people, let's say, and they're fighting each other. So at the end, there is no winner from this fight. And in this particular moment, it's one and the same thing. The 2 parties are fighting. They cannot raise a winner. So that is why the price is closed on one and the same place. Indecision on the market, right away, it means that a change of price of direction is imminent or is near. So basically, when we see a dodgy line, we need to start looking very close to the market so we can spot a formation that is going to hint the price direction. That is why we need those dodgies, and that is why they're so important. In most of the time, when you're putting up your chart, let's say, me personally, I'm putting a color only for those types of candlesticks to appear in red color because they're important, and I need to be looking at it at every particular moment. Thank you very much for your question. I hope I was, of course, I filled the question well enough so you can understand it. There are a few other questions actually which are not relevant to today's topic. Basically, it's regarding one of the topics from last week. I will manage to answer all those questions yet again after the session is concluded today. Now, I will pause the screen for a moment so we can switch through the live chart. Now, what we see here is our MT4. Now, what we have is just an example, gold daily chart. Let's say I've got a few trades running down here. I'm testing a few different types of strategies. So basically, I'm going to hide that away so it doesn't disturb you that much. Now, ladies and gentlemen, what it appears right now here, the first thing in the last few days, as you can see, of our downtrend on gold after just before it got breached out, what we saw is one very important thing on the top of an uptrend. Now, let's put the uptrend first. Now we have an uptrend. This is our uptrend. It was broken over here. Now, what we see on the top of an uptrend, ladies and gentlemen, is one of the formations that we're talking about today. Now, this is an evening star. As we mentioned, regardless of the color of the middle candlestick, right now we can see that it's a white one. The first session is a long white candlestick real body, followed by a very small white candlestick real body, and after that an immediate huge black candlestick real body. Now, the absolute potential of this position from here, as we mentioned, let me make a slight deviation if some of you are wondering when exactly to exit. Let's say we're entering in the absolute rule, which is over here. This is your entry. This is your entry point. The absolute potential is from the opening of this price over here, from the starting of the development of this type of formation. The distance between here and here is, as we call it, the absolute potential of it. But if it occurs on an uptrend, it's so powerful that it might change the price direction, as it actually did. Now, pretty much at this particular time, we saw a lot of fundamental news that actually changed gold price imminent. But as you can see, if we measure the size of this position from over here to over here, we can spot that it's about 8.8, approximately $9. We can measure the next candlestick where we opened, it's about $11. So basically the real bodies of those two candlesticks are very close as magnitude, as size. So this is your profit, just to be sure. Now what you see after that is a huge day with a sell-off. That's fundamental. Now we're talking about Federal Open Market Committee, the decisions that they were making the last few weeks regarding the U.S. economy. They're affecting gold and oil majorly, of course, the euro dollar as well, and the currency pairs that are connected to the dollar. But talking about gold as hedge against inflation, those types of news play a huge role. And as you can see, we have a bounce off, slight bounce off the main trend line over here with about $17, which is pretty good. And the broken trend drives the price even lower. Now what we see on the bottom of a trend line, ladies and gentlemen, is again this type of formations that we were talking about. There it is. This time we have a Morningstar, a long black candlestick real body followed by a very small black candlestick real body and a very long white candlestick real body, continues to the upside. So that's what we call it, a short-term trend reversal. But talking about different strategies, some of you guys might have noticed this morning's analysis that I've made a few conclusions about the price movement for the past few weeks. It's actually closed between ranges, which gives a range trading. This is one of the ranges here, and this is the second one. Now this is a very big price, price bracketing, but there is a secondary, as we mentioned, range, which is this one over here, and you don't look at this one because this is just a fake breakout. We have our swing highs and swing lows. Now, I'm not going to go too much into it, basically, because it's not today's topic. But what I mentioned is in a side range trading, you can see very sharp moves and the development of those types of formations. Yet again, we have an evening star over here. This time is an evening Dodgy star, very powerful one. You can see that after the Dodgy, a very huge black candlestick with a very huge, as we mentioned, shadow to the downside, and the price still continues. Now let's measure the potential of this position. Let's say we actually took an advantage of it. So let's erase it. Check out this type of position to see what's the potential of it. We have about $24 change in price, and we have about $20 change in price. That is why I'm saying sometimes it's necessary to put your take profit a little bit conservatively speaking. Smaller take profit, but sure take profit is what we like to call it here in our company. It's one of my mottos. Basically, yes, of course, the price goes down. If you set up, let's say, about $24, $27, if you wish, the price goes down even $34 further down. But let's say we're talking about closing, because you need to exit this position. That is why you need to look at those real bodies. Yet again, if you have set up a take profit and you have made your entry on this type of Dodgy here after the closing of this session, where it should be absolutely appropriate, you have a move in the next few days that drives the price down to $34, which means our initial target of $27 has been hit. We have collected our profit, and as everybody knows, or some of you might not, but we will cover this topic again in the next following weeks, how to equalize your positions and what's your profit potential. On one lot, this is $2,700 profit. Now, let's take a look at some more patterns in the past to see whether we can spot something a little bit different. Now, what we see on this type of a something like a double top formation, we have our dark cloud cover. We also have a again the Dodgy star. So you can see those types of formations on major trend reversal points, which drives the price strongly down or up regardless of the direction. So we have one very huge, very beautiful formation over here. Now we have a dark cloud cover over here. Now sometimes you can see an imminent, as you can see, the potential from here to here has been confirmed with the long candlestick from here to here. So it usually confirms. Sometimes the profit is smaller, of course. That's why I mentioned, and I will keep doing it. Be conservative, take smaller profit to be sure that instead of course, that instead of profit, you're not bearing a loss. That is why it's one way to ensure your profits. Now, talking about a sideways trading, bracketing this price between two lines, you can visualize those types of formations again. You can see it's a short-term reversal. After a sharp move to the upside, you have a sharp move to the downside. Basically, this can repeat in the future as many times it has already repeated in the past. What we see here is a slight uptrend. Now, this is just a correctional move from the main trend here. As I mentioned, we have those types of engulfing patterns that drives the price to the downside with the absolute potential of the previous session. We can keep doing that all day, and we can still find them on the chart. What I'm trying to show you with all that is that it is easy to find them when it's already happened. One of the questions during the session that I got right now, so it reminds me to tell you, let's consider that in time this one will happen again, and how exactly are we going to spot it? Let's scroll to present day and see exactly what we have. Present day trading. Let's say that this is a sideways range, as we already mentioned. Now, what we anticipate in the next following days that it might happen, we need to wait to see how this candlestick will close, right? If it closes above this range, it's probably going to be a continuation. Then the resistance is going to be up here. So we're going to wait until we see what's going to happen. Now, the next thing is, if this price bounces below this line, we need to look at the second candlestick that it's going to close. Let's say, for example, it's Dodgy, right? We need to wait for the third one to visualize if we're going to have an evening Dodgy star. Now, if we have a candlestick like this one, a black one, for example, the next session's opening, we should consider entering our short positions very soon. It could be a slight bounce off with a shadow to the upside, but we shouldn't be scared because this is formation that it usually confirms. That is why we have our stop loss to protect our investment. Our stop loss should be a few pips above the highest shadow. Now we're talking about the shadows. That's where they're important about our stop loss. We should really consider putting our stop loss a few pips above this line, as we already see that this is a resistance here. We see that the shadow is below it, so we put it a few pips above here to protect our investment, but instead the price goes down to our potential profit and hits our target. So our absolute potential is from here to here. This is our profit potential. Those types of rules are the thing that you need to have on a piece of paper in front of your computer if you want to be a successful trader. What we're learning today is we're learning how to anticipate the next market move. To see that and to find the proper way and the proper levels of entry, we need to look at the bigger picture. And this is a daily chart or a weekly chart if you wish. Depending if it's Friday, you definitely look at the weekly chart. You need to know where exactly the market is going to close, regardless if you're looking at gold or oil or euro dollar or any kind of currency pair or commodity or stock or company share, whatever it is. Still, this is important for you guys. You need to anticipate the next market move. So you need to calculate the old school way with a piece of paper and a pen. You write down what's the profit potential and what's the risk that you might be able to bear. That is why those levels you need to be setting up correctly. Now, talking about this type of formation, okay, sure, not a problem. But we have many more. It's not the only formation possible to happen. We might have an engulfing one or a piercing or a dark color cover regardless of the direction. Let's say we have a long black candlestick closing below the middle of this previous session. Then definitely the opening of the next session, we need to look for a strong, powerful move to the downside with the potential of the first session. Now, this is not because I know it's going to happen that way. It's only because I'm anticipating it. Now, if it's going to move to the upside, you need a continuation pattern, or you need a continuation confirmation. That should be a breach above certain levels, simply because it's already going up. But talking about trend direction, that means we need to have slight correction before we see further upside. Otherwise, it's not going to be sustained. It's going to be too steep, and the downfall will be great. I see that a lot of questions coming my way. One of them, very interesting one. How can you actually know that this will happen for sure? There is no 100% certainty in anything. Yeah. What you need to understand is the more accurate you actually set up your chart to work for you, the less currency pairs or commodities you're actually looking at, you will better know what's the behavior of this particular instrument, and then you will know what to expect from it. You will follow the news, you will look at the chart, you will expect different types of formations to occur, and when they do, you make your entry. Now, we have a webinar this Friday. It's going to be with the topic of technical indicators. This is the moment in which I will actually tell you and show you how you can use other types of indicators on the MetaTrader 4, such as moving averages, Bollinger Bands, some other types of oscillators that you can add up only because you want to make your trading easier and find the price direction better. My name is Joseph Novichkov, Senior Commodity Analyst at GDMfx. Thank you very much for joining me today. I will still leave you 5 to 10 minutes to consider a few questions if you have. Some of those questions that I'm getting here are a little bit off the topic today, so I will engage with these guys after the webinar itself. So let's have a break about 10 minutes, consider your questions, and I'll be back to help you out with that. Thank you. Hello, ladies and gentlemen. Joseph Nochkov is my name, Senior Commodity Analyst with GDMfx. I'm hurrying up to open the QA session of the webinar today. Basically, there are a lot of questions we need to cover. The time is very short. I've got a lot of trading to consider. In the next 20 minutes, we will see U.S. market opens. And yet again, the market is going to be it will be very volatile. So we don't want to miss the chance to make a lot of money during the U.S. session until we're at the office, our European office for GDMfx. Now, the first question I want to address is it's regarding something very important we spoke already about, so I need to cover it and I can go to the actual trading itself. Now, I've been asked to dispatch this recording session through email. Now, first, let me remind you, this is about 1.5 hour recording, and the session is too heavy to be uploaded to an email. So even if I want to do it, I need to do it partially by 2 megabytes, which is going to be about 300,000 files. So that's a bit impossible to happen. Therefore, what I can do, for those that are difficult to find our YouTube channel, what I will do is I will kindly ask you for your contact details. Let's say an email, a telephone number, or an account number if you have one that is with us, so we can find your contact details, and I will send you the direct link so you can look at it. So you can see that that channel. All of the webinars are uploaded over there a few days after the webinar itself. And there are a lot of questions about when would I have time to attend in one-on-one sessions. You need to understand this is possible, yes, of course, without question. Whoever needs that, we will do that for you. Now, I would like to display again the previous page, which is about the webinar. If you see it, this is the contact details. My email is below it. Please send me your contact details so I can know where to dispatch those links to. And yet again, how to contact you for one-on-one sessions. We will be able to do live trading sessions if you wish. And of course, all that we have is available for all of our traders. Now, the question that I would like to address next is if the candlestick behavior changes according to fundamentals, to the fundamental news. Now, it's very important, guys, to remember that the hedge funds, let's say the big guys, those with a lot of money, they anticipate the news earlier, and whatever happens on the market, it's already concluded even before the news. So basically, okay, I hope everybody got my email address. Let's go to the chart so I can show you what I mean. Now, this particular moment here for gold, it's exactly where we saw the announcement of the tapering from the Federal Reserve. Now, the Federal Reserve is a powerful combination of different people that actually decide the future of a single country. In this particular moment is the United States. In different countries they're called different ways. Basically, they've decided to start tapering the monthly purchasing of government debt, also called government bonds. Now, what they were doing since the crisis in 2009, they have applied a program that was purchasing every month a solid sum of money of government debt to ease the economic conditions and improve the business possibilities in US. Now when they start tapering, of course, what happens in result is that, of course, by understanding the economy is improving, what we need to see is a strength in US dollar. Automatically, gold is falling down because of that result. That is why we see in alignment those types of formations. Now, yes, the answer to the question is yes. They do behave in according to fundamentals, but not all of the time. Now, some spikes you can see on the market, sudden spikes, how we like to call it is, let's say, extreme market conditions. This is when some kind of announcement again, or an economic event, some kind of a number, for, let's say, let's give an example with the Purchasing Managers Index for US. Now that's something that can hit gold or any kind of currency connected to the US dollar and cause a spike in price. What you will see is a very long candlestick regardless of the direction, and before the ending of this session you will see the market retreating to where it came from, leaving a shadow, basically because more of the traders out there are looking at the technical chart more than they're looking at the news. Of course they are paying attention, but there are a lot of traders that are actually relying on the mathematical method to calculate future price behavior. That is why those types of formations are so often seen, because there are a lot of people looking at it. So when they see it, they take decision and they are making their positions, taking their profits. So you shouldn't be fooled by the fact that I'm saying they correlate one with each other, talking about the fundamentals and the technicals. Now, combined, it's a very powerful tool. I will teach you how to use it, because having all that in your two hands, these are going to be your punching gloves, and this is how you're going to trade on the market, whether you're going to use one of it or the other one. In time, you will become traders as good as any other, recognizing those types of patterns. So once again, to address this very important question, so I'm very thankful for the person that is asking it. The correlation between the technical chart and the behavior according to fundamentals is not always one and the same. Basically, they do not align always. But when they do not align, you can see sudden spikes in the market, and the price will definitely retreat back from where it came from, because we want to see that type of pattern that tells us the price will reverse or continue. You know, there should be a pattern, otherwise it will be a chaotic move on the chart, and basically what we will do there is just gamble, and trading is not gambling, it's pure science. Right. Now, in many of my sessions, I've been asked questions such as how long time will it take me to learn this? It's one of the next questions that I'm getting. Now, this is very important to remember, guys. Time is of the essence. So if you would like to become a trader, you need to press on, and you need to get that material, print it out, read it, study it. After that, when you're completing this homework from you on your own, you can come to me so we can make some live trading chart. We're going to put some trades on it. We're going to see exactly how the market is behaving. You can see my screen if you wish. You can see exactly how I'm placing my positions, how exactly I'm making my decisions. Yet again, remember, this is not a trading recommendation. It's my way of trading, pretty profitable one. I'm using different types of strategies for different situations, only because I recognize the situation. And I will tell you about that because I've been asked again in what situation you can use those types of charts. I will repeat it again numerous times today, but good thing you're asking, because you need to remember that. You can use it in all time frames. You can use it in all currency pairs or commodities. In any instrument that you want to trade it, you can use it. The only difference is how they appear. Now, it could be an ugly one, it could be a very beautiful one, but still it's one and the same candlestick pattern. So that is what you need to train your eye to recognize them. And you will recognize them when they confirm. When they confirm, there are some of those positions that you will make that will actually lose a bit of money, but that's not necessarily a bad experience. It's just an experience, because this is what you're getting on the market, an experience. Eventually, in time, you will become so experienced and you will train your eye so well that you can predict that this type of formation is with a less percentage certainty. So you're either going to take it but with a very, very small take profit, or you're going to wait for a bigger formation that it's much more powerful on a bigger time frame if you wish, so you can make more money. But be advised, those types of formations on big time frames takes a lot of time to develop. As you can see on the top of this gold uptrend, we see that this one is developing for 3 consecutive days, and the range is pretty huge, $30 direction. So if you rush too fast to take position earlier so you can catch a better price, you might be caught off guard and eventually lose the money on the market. Now, this is one of the things I do not want you to do. Wait for the confirmation. The longer you stay on the fight, the more you will profit from it. So there are a lot of these types of rules that I would like to share with you. Time is pressuring us too much. I need to make my technical analysis for the US session, which is starting in less than 10 minutes now. I'm very grateful to make this webinar for you. Come to the webinar on Friday. I will show you a few technical indicators, how you can combine all of this from the chart and make it a successful type of trading strategy. Let me remind you one more time, the recordings will be uploaded in the next few days. You can find it in our channel. If you don't find it, please send me a request. I will send you right away the link so you can see that recording, basically because this is for you. Thank you very much. Joseph Novichkov is my name, Senior Commodity Analyst at GDMfx.